time to go. My name is Dave Beattie. I'm the Legislative Compliance Manager at HR Talk Outsourcing. Today I'm presenting our 24th Legislative Update webinar. I'm going to try and cram this into an hour because I know everyone's busy. Today we're going to cover some of the issues that were dealt with in the budget. I'm also going to deal with issues such as basic conditions of employment changes, minimum wage changes, COI changes, UIF changes, and I've also included some issues that are badly dealt with in the payroll space. So I'm going to go through those, and what I'll do is I'll answer the questions at the end. So if you've got any questions, please just type in the question. You're also welcome to drop me an email. I'll confirm my email address at the end. If you're too shy to be named, I will happily answer your questions. And I think let's get cracking. Just please bear with me. I did have some problems with one or two of the slides previously. We've tested this morning and it all looks good. So just hold thumbs. Okay, first slide, all I've done is I've included the tax tables for 2023, 2024. You'll see that the marginal tax rates in each of those bands stays the same, but we will cover the nitty-gritty around the tax tables shortly. The brackets have been adjusted to cater for inflation, so they're talking about 5%. The brackets have also been widened slightly, so that means that as you get increases, there's more of a chance that you will stay in the brackets a little bit longer. As I mentioned, there's no tax increases in each band, which has been the case for many years. The lowest rate remains the 18%, and the highest rate remains 45%. There has been talk of that 45% going up, but as I've said there, SARS realized that they can't kill the golden goose. There comes a time when people in that 45% brackets rebel to the amount of tax they're paying, and whether that be VAT, income tax, tax in their companies, transfer duty. There comes a point where the person will not pay any more tax, and their tax morality changes. So we're grateful that it stayed at 45%. There's your tax rebates. You'll see that the rebates, primary, secondary, and tertiary, also went up slightly, as did the thresholds. You'll see that the thresholds for under 65 went up quite a bit, from 91,250 to 95,750. So that means that if you're under the age of 65, you will not pay tax until you've earned 95,750. And the same logic applies to those ages mentioned below. In this slide, you'll see that the medical aid tax credits have also changed. They've gone from 347 to 364. And then the secondary for additional dependents after your first dependent goes from 234 to 246. I've then included how the medical aid tax credit works in terms of claiming the additional medical aid tax credit. And you'll see that there's two different formulas, one for over 65s and one for under 65s. On your tax return, SARS takes into account medical aid contributions, your medical aid tax credits, and then other qualifying expenses that you may have incurred that wasn't covered by the medical aid. And then subject to that, for those two formulas, you will get this additional medical aid tax credit. Now, in my experience, the over 65 score the most, and some of my clients are getting a 20,000 Rand deduction in their tax liability just due to this medical aid tax credit, the additional credits. Travel reimbursements, very important. We're going to cover this in a bit more detail later on, but the travel reimbursement per kilometer went from 4.18 to 4.64 per kilometer. And then I've taken the liberty of putting in the travel table below This is the table that SARS uses if you submit mileage on your annual tax return and you don't put in actual expenses. In my experience, generally, it makes sense to not claim actual expenses unless your actual vehicle expenses and fuel expenses are ridiculously high. And I mean ridiculously high in terms of sales rep type levels. Otherwise, just put in the opening closing mileage or vehicle details and SARS will use this formula. Okay, I've also included this slide. I included it in previous years. It's just a good way of calculating a travel allowance for an employee. I do not suggest that employers thumbsuck an amount because you can get the employee into trouble. So points 1 to 7 just cover the logic that has to apply in arriving at the most cost-effective or most tax-effective travel allowance. And the first step in that is the employee would have to confirm what the cost of their vehicle is, including VAT and extras. You wouldn't include finance charges in this. They would then give you an estimation of the total mileage that they're likely to do and split that between business and private. Going back to the previous slide, you'll see that there's a fixed cost. So if your vehicle is between 0 and 100,000, you'll see the fixed cost is 33,760. And then you've got a fuel cost per kilometer and then a maintenance cost per kilometer. These elements all fall into this calculation. So you would basically take the fixed cost as per the previous table, and you would divide that into the total estimated kilometers for the year to get the total fixed cost per kilometer. You would then add to that fixed cost per kilometer the petrol per kilometer and the maintenance per kilometer as per the previous slide. And once you've got a total per kilometer, you can multiply that by the total estimated kilometers per annum to arrive at your travel allowance. I prefer to multiply by the estimated business kilometers, but it's important to get your travel allowance to a point that it gives you the maximum ability to claim a deduction. Remember that on assessment, if your travel allowance is 60,000, you're only going to get a maximum deduction of 60,000. So if you qualify for 100,000 travel deduction, make sure your travel allowance is big enough to deal with that. Now, I've done an example here quickly for you. In this case, the vehicle is 250,000. So if you go to the table, the fixed cost is 86,958. In this case, the employee does 15,000 per annum. So divide one into the other, you get R579.7 per kilometer. You add the fuel of 1717 and the maintenance of 0.604, and you get a maximum rate per kilometer of effectively R8.12. Times that by the business kilometers you anticipate doing, and in this case, that comes to a travel allowance of 65,000 Rand a year, 5,412 Rand a month. If you go this method, you're unlikely to make a mistake, and SARS would also prefer the travel allowance to be quantified on this basis. Okay, I've then also taken the liberty of attaching this travel allowance taxation table. This table is worth its weight in gold because I get queries every single week from employers asking, if I do this and I do this, what are the implications? And what this table will show you is all the scenarios. If you, for example, get a fixed travel allowance, then PAYE must be deducted and it must go to 3701. But what happens if you get a fuel card and expenses paid? Both of those will go to code 3701 as per the second column, second row, sorry. And then what happens if I get reimbursed? What happens if I have a travel and I get reimbursed? And All those issues are covered on this table. So please have a look at it. It's a one-stop shop for all your answers. Then I've taken the liberty of also attaching just some examples, and you're welcome to go through this in your own time. But what it does is it shows, if the employee does 20,000 kilometers per annum, and in some of the cases, well, in all of these cases, they're getting reimbursed per kilometer, but in some cases, they also got a fixed travel allowance. It will show you exactly where these codes go. So maybe let's just go through it quickly. In the first case, you're getting reimbursed R2.61. So the first step in that logic is it above or below the R4.64? It's below. So we all know that if this person gets reimbursed 52,200, because they're getting reimbursed under the SARS rate, that recording in terms of RP5 purposes will go to 3703, non-taxable reimbursement. No need to hand a logbook in with your tax return. The second scenario is very similar. It's just that we are going on the SARS rate. So because we're using the SARS rates, the same logic will apply. There's no tax implication other than reporting this to code 3703. Then we've got a case of the employee gets R5 a kilometer. Now, first step is that above or below the SARS rate, it's above. So we know that there's going to be more reporting. Now, a more recent reporting in the last couple of years is you have to record the reimbursement amount that exceeds the SARS rate in code 3722. So in this case, the amount that exceeds the SARS rate is 7,200, so that must go to 3722, and then the balancing amount goes to 3702. Remember that the balancing amount, the 92,800, is effectively the R4.64 times the 20,000 kilometers. It's only the balance of the amount of the 100,000 that you reimbursed in total that goes to code 3722. And that is taxed monthly as a travel allowance in your payroll. Then we've got an example of the employee getting reimbursed at R2.61. So you can see that they're going to get 52,200 again, but they also receiving a travel allowance, and in this case, what you need to know is there's nothing against code 3722 because the employee is getting reimbursed at less than R4.64, and 52,000, the total amount reimbursed, will go to code 3702, and obviously 8,000 of the 10,000 is taxable in the month, because the person's also getting a fixed travel allowance. The same logic applies in the next one, where the person gets the SARS rate, but let's go to the last line. Once again, you need to understand that because the employee is getting reimbursed at R5 a kilometer, we're going to have the same 7,200 Rand in code 3722. We're going to have the 92,800, which is R4.64 times the 24,000 in code 3702. And now in the last column, the amount that is taxable on a monthly basis is going to be the sum of the 7,200 and the 8,000 fixed travel allowance that the employee gets. I know that's quite a mouthful, but if you've got any questions on this, please contact me, because it's quite important that the employee knows why they're being taxed and what the requirements is in terms of them when they hand in their tax return. So the important points to remember: any reimbursement amount in excess of R4.64 is added to normal PAYE purposes, code 3722. The excess amount must also be included in code 4582, which your payroll will do. When a fixed travel allowance is paid in addition to a reimbursement allowance, both amounts are combined on assessment and taxed as a travel allowance. So that can be a problem for an employee who's got a massive travel allowance and a massive reimbursement. They might not have enough business kilometers on assessment to keep their travel allowance tax-free. And most importantly, don't make your travel allowance disproportionate to your other remuneration components. This creates audit risk for the employee, and it also creates a situation where SARS might want to look at you and do an audit. Subsistence allowances, they went up to 161 Rand per day for incidental expenses and 522 Rand per day for meals and incidentals. As of March 2021, you could also, if the employee is going to be out the whole day, you could also give them 161 Rand to pay for incidental costs. Now both of these amounts relate to situations where the employer pays for the accommodation when the employee is away on business, and the employer doesn't want to have to deal with slips when the person comes back. So you can enter into an agreement with an employee to say, listen, we'll give you these amounts, and then you spend those amounts, and then they go to tax-free codes on your RP5, and you don't have a reporting requirement. These are also often ideal if the employee is going away and they're going to be staying with family members. Obviously, they're not going to have slips in that case. No company car fringe benefit changes. SARS interest rates. The first line is the most important because that is your interest-free loans interest rate, 8.25%. We're expecting that to go up in the next month or so. But that is the rate that you have to charge your employee if you loan them money in excess of 3,000 Rand. So if you enter into a 5,000 Rand loan with an employee, you would have to set up the payroll to calculate 8.25% interest as a fringe benefit if you are not charging interest. The other two interesting points about the slide is that if you fall foul of any payment to SARS, you are levied with 10.5%. But if SARS owe you in terms of an overpayment for any reason, they only pay you 6.5%. This slide just shows your company tax rates. The interesting point is after March 2023, any year end for a company, your company tax rate goes down to 27%. This slide covers small business corporations, just to show you also the split in depending on when your financial year end is. Interesting to note that the 91,250 and the 95,750 is the same figure as the rate at which an employee starts paying tax, and that's not there for nothing. It's just there so that you everything is tax-free up to the point in which the employee starts first paying tax. This is your turnover tax for micro enterprises, and there's no change. I don't have one client on turnover tax. Transfer duty, the important part, look on the right side of the slide. You'll see that the bottom threshold has gone from 0 to 1 million to 1.1 million. So that means if you're going to go buy a home for less than 1.1 million, you're not going to pay any transfer duties. And you can see that the slide, every single band has been altered accordingly. What SARS are trying to do is ensure that transfer duty is only paid by obviously your higher earners, and that property is affordable to lower level employees. I just included the ETR slide from last year again. This changed in March 2022, but there was an increase of 50% in terms of what the employer could claim for a new employee in the qualifying age category. So, yeah, in the first year that went up from 1,000 to 1,500, and year two from 500 to 750. all in an attempt to have more people fall into the ETR brackets and employers to get a benefit. Important to note that as long as the employee meets the qualifying criteria, that month counts towards the 14 months qualifying months. Whether the employer actually claims a benefit is irrelevant. So to summarize, the length of the 24-month period is therefore determined by the number of months that the employee qualifies for ETR. If the ETR is not claimed in a qualifying month, it can be claimed in the next month, provided the claim is in the 6-month RP5 cycle. Also creates significant challenge in terms of keeping track of where you are, and getting out of sync in terms of qualifying periods and claims can result in an audit. Most payroll systems will guide you sufficiently to prevent you getting into trouble. Something that was new in this budget is a proposal to amend the Act to facilitate imposition of understatement penalties on ETR reimbursements improperly claimed. And to do that, some changes needs to be done to the wording of the Act. Reimbursements will be classified as refunds, and if you claim a refund that is not due to you, expect to get a ETR penalty. But as this legislation is rolled out and we have more information, we'll explain this more. The effective date is purported to be September 2022, so that falls into the 6-month ETR cycle, September to February 2023. Then we've got a long-awaited introduction of expansion of tax incentives to promote renewable energy, and it's important to note that it has to be to promote renewable energy, not save energy. Businesses can now claim 125% deduction in the first year of these energy renewal products, with no threshold on generation capacity. And the adjusted incentive is only available for investments brought in for the first time between March 23 and February 2025. So if you've got taxable income and you are introducing these types of plans, you can expect to see a reduction in tax liability. There's also incentive for individuals to invest in solar photovoltaic systems. Individuals will get a tax rebate of up to 25% of the cost of any new and unused solar PV panels. So the catch there is they're new and unused. It can't be something that you've installed previously or second-hand systems that you bought. So to qualify, the solar panels must be purchased and installed at a private residence. There must be a certificate of compliance for the installation, and that must clearly state that it's in the qualifying period 1 March 23 to 20th February 2024, and it must be fixed and a minimum of 275 watts per panel. So the requirements are very, very specific. So the rebate is only available to solar PV panels and not inverters or batteries. So as I said, the intention is to focus on the promotion of additional energy generation and not energy saving. And it can only be used to offset the individual's personal tax liability in the 2023-24 tax year, up to the maximum of 15,000 per individual. Quite disappointed with the 15,000. I'm hoping that if this is dealt with efficiently and successfully by taxpayers, that might go up in the new year. The incentive at this point is only available for 1 year. We've got some changes in the retirement system space. The first phase of legislative amendments is due to take place on the 1st of March 2024. Your retirement contribution limits of 350,000, 27.5% of taxable income is unchanged. Permissible withdrawals from funds accrued before 1 March 2024 will be taxed according to the lump sum tables We're going to talk about the savings pots and the two-pot system. It's actually a three-pot system in future slides. But for this purpose, withdrawals from the savings pot before retirement will be taxed at your marginal tax rate. That means the bracket that you fall into, what is the tax rate in that bracket? 18, 21, 26, 31, 36, 41, 45, those type rates. On retirement, any amounts retained in the savings pot will be added to your retirement pot and taxed according to your lump sum tax tables. Now, your lump sum tax tables are the ones that give you the exemption between 0 and 550,000 for either lump sums from a retirement fund when you're at retirement age or retrenchment. The de minimis rule of 247,500 stays the same. So if your fund is at that value or less, they'll allow you to take all of your money at one time. Retirement fund members could in the future take one taxable withdrawal a year from their savings pot, where up to a third of their contributions could potentially be withdrawn. The remaining 2/3 in the retirement pot has to be preserved until retirement and used to purchase an annuity. So the logic there is we're going through tough times. They do not want people to resign just to have access to their retirement funds. They do not want people unnecessary to get into financial trouble with retirement funds. So what they're doing is they're saying they will give you access to the 1/3 prior to retirement, and then the other has to be actually used to buy your annuity pension to cover you for the rest of your life. So as I mentioned earlier, there's three effective pots. The vested pot, so that's the amount that's in this fund prior to the implementation of this change in legislation. Then you've got your 1/3 accessible savings pot, and then you've got your 2/3 retirement pot, which has to be preserved and paid out as an annuity on retirement. There's lots of unknowns at this point, but what we do know is preservation funds will be required to implement the new system. So that's any money that's been put in a fund out of your retirement fund to preserve, to park it until you decide what to do with it. Retirement annuities will be included in the new system. Defined benefit funds and the government employee pension fund will also be included. Remember, the system only applies to contributions made after the implementation date. The extent of vested rights is still under consideration. Amounts withdrawn will deplete the amount available as a lump sum on retirement. That makes sense. I mean, if you leave all your money there, you're going to have a bigger lump sum. If you take 1/3, you're going to have a smaller lump sum. And as I also mentioned previously, employees can now access their retirement savings without having to terminate employment. It was a big problem. Those of you who may have traveled overseas would have, particularly out of King Shaka International Airport, where it's on a voluntary test. In fact, it's only applicable at King Shaka. There's a new online modern traveling management system that's been tested since November 2022. The aim is to strengthen SARS capability to facilitate legitimate traveler movements. So SARS BDRs are watching you. It's also to provide travelers with clarity and certainty regarding their obligations. It eases compliance and detecting non-compliance, so that's only obviously for SARS, and it improves enforcement for SARS. The Customs and Excise Act will be amended to provide for the declaration of the required information upon arrival or departure in South Africa. So once the system test has been evaluated, if it's successful, there will be a change in the legislation, and you will be doing this process at all airports or departure points, knowing that SARS are getting this information and going to be used against you should you be immigrating or should you be flitting in and out of the country trying to avoid tax. We've also seen significant PAYE and personal income tax administration reforms in the last 2 years. The biggest of those is probably relating to pensioners and multiple sources of income. If you fall into that category, you would have got another letter from SARS this year saying, do you want to increase the amount that your pension funds deduct so that you don't owe money on assessment, or do you want to just let them withhold according to the tax tables? Most of my clients have just gone tax tables so that they can keep the money and only pay SARS on assessment, but SARS is concerned that there are thousands of pensioners who can't afford to pay that money on assessment, and then SARS have a collection burden. It's also important to note that 2.9 million individual taxpayers out of the 19 million were auto-assessed in the 2022 tax year. SARS are looking at measures to reduce the administration burden for employers, payroll administrators themselves, and salaried taxpayers. As I said to you, SARS did have challenges with pensioners owing money on assessment because they had numerous forms of income and they were all taxed individually. When you add those amounts together, the tax rate is higher and the person would owe money on assessment. That's unless the pension has significant medical aid expenses and additional medical aid tax credits that would potentially wipe that out. So it's important that you speak to your tax consultant as to which of those methods you want to use if you are a pensioner. SARS and various stakeholders, namely the tax authorities, payroll auditors group, have been working in the background, also with large employers, to look at the feasibility of changing the employer reporting requirements from a biannual to a monthly basis. As the slide says, this will require massive systemic changes. SARS are eager to push this through and to make this easier. Process will be fully automated, and obviously then there will be no annual or biannual reconciliation. But your payroll software suppliers are working with SARS as we speak to look at practicalities in this space and to see how this process could be easily implemented. SARS are keen on this information because they say they'll get better information, and they can also budget and estimate better as they're getting real-time information. Whether that's a good thing or a bad thing for the taxpayer is another story. We would have read a lot in the press about specialized SARS units. There's a high net worth taxpayer unit. They're looking at 1,500 individuals and their related companies to see whether they require investigation. In my mind, that's the low-hanging fruit. It's easy pickings to tackle those people. SARS are not doing enough to tackle the people at lower levels who are operating spaza shops, taxis, informal businesses that are not paying any tax other than limited amounts of VAT. Interesting to note that provisional taxpayers whose assets are more than 50 million will now be required to record their assets on their tax returns at market value as opposed to cost value. And quite rightfully, you know, if the market value of your assets has gone up significantly, you're going to need to explain this unexplained wealth. No one's shares have gone up that much that would worry SARS. And then obviously this information is used later to do capital gains tax calculations and compare declared versus actual. Nasty spot to get into. So if you're a high net worth individual, make sure you've got a good tax consultant who's not going to get you into trouble. Then we've got this new SARS USSD service. SARS are acknowledging that not all taxpayers have the same resources and not everyone's got a smartphone. So they've created this additional channel so that the taxpayers who have older phones have additional channel to have access to services and to stay on top of their tax obligations. It'll make easier communication with SARS. And I've just listed there in terms of the number that you'd have to dial to interact with SARS. This slide just shows the process, in terms of the 4 menu options. You can check whether you've got a tax number, you can get your account balance, whether you need to submit a tax return, or if you'd like to book to visit SARS, you can do it via this new SSD service. The service is free and doesn't require data, and it's been available since the 20th of March of this year. The next slide is quite a technical slide, and a lot of taxpayers may have a problem with this and a couple of additional slides that we're going to go through. This slide deals with when a taxpayer ceases to be resident during a tax year. So you cease to be resident the day that your day of assessment ends on the day prior to you ceasing to be tax resident. So you're going to have a tax year between the beginning of the tax year up to that date. And then your next tax assessment is going to start the day that you cease to be tax resident. Very, very technical and can get you into significant trouble if you're a provisional taxpayer. It's important that your tax consultant is aware of the provisional tax implications with this double tax year in one tax year situation. So if you need help, let me know, and I'll pass you on to Megan and her team. So as I've said there in the next point, you've got 2 consecutive years of assessments in a 12-month period. This has unintended consequences. So you can essentially claim exemptions and exclusions twice. And I've just listed the capital gains tax exemption of 40,000 and the 36,000 a year that you can contribute to a tax-free savings account. SARS are aware of this and they're looking at this. As soon as we get any changes, I will put something in the newsletter out to all of you people. Moving on to long service awards. This was finally looked at last year. I deal with at least 2 or 3 of these a month. So I thought it was important to just cover the issues again. Remember that you can only provide a long service tax-free benefit to an employee if they've worked for 15 years of unbroken service, and then unbroken service for every 10 consecutive years after that. So just as an example, I work here for 15 years. In year 15, I can get my exemption. In year 25, 35, 45, 55, 65, I can get also the exemption. If I'm going to give my client, my employee, the long service in year 20, then they would get in year 20, 30, 40, 50, 60. As of March 2022, the 5,000 exemption now also applies to cash payments, whereas before it only applied to assets. Remember that gift vouchers have always been regarded as an asset and not cash. So they were valid means of rewarding your employee for long service. Kruger Rands are also assets and the exemption would apply to them. So in terms of doing the long service award tax calculation, have we met the criteria, the 15 and 10 subsequent consecutive years? Yes, we have. Can we value the award? And then now we have to deal with the tax implication of the award. And that is, if it's 5,000 or less, it'll be tax-free. If it's more than 5,000, only the first 5,000 will be taxable. Now, you've got 2 RP5 codes to differentiate these awards. The first is RP5 code 3622, and that should be used to report long service cash award. So the full value would go into that code. If you're giving the employee an asset or free or cheap service, you would put it into code 3835, same as the full value. SARS will then reduce the amount by the lower of the total amount and 5,000 of the amount in these 2 RP5 codes. as I've said there, so the sum of code 3835 and 3622 becomes the value that is used to determine the tax due. As part of the award could be in cash and part could be in a free or cheap service. The tax implications are as per those two bullet points below. Obviously, if the sum of those two codes is less than 5,000, there's no tax benefit. If it's greater than 5,000, then the amount that exceeds 5,000 is the taxable benefit. I've just put in a table here, thanks to Rob Nowicki, for showing you the various scenarios of a long service award, the various amounts, the various RP5 codes, what portion would be taxable and what portion would be non-taxable. Very nice thing to refer back if you do not understand this concept. Moving on to bursaries. Once again, the slide is thanks to Nowicki and Associates. This just shows you the exemptions that are applicable to bursaries. Now, in this case, it's bursaries provided to relatives of employees. Important to note the 600,000. If the employee earns under 600,000, they qualify, and then you can see there that you've got your NQF levels, and you've got your rand amounts per year, depending on whether the person is disabled or not and what NQF level they are studying in. This slide just shows the RP5 codes applicable to those payments. Just a reminder that salary sacrifice can no longer be used to factor bursary into an employee's remuneration package. We've gone backwards and forwards with SARS over the years. Is a sacrifice in this space acceptable or not? SARS changed that as of March 2022. It's no longer acceptable. So if you are going to give an employee a bursary for their child, you cannot reduce their. So, like the next point says, there cannot be a salary sacrifice element. The exemption will only apply if the bursary is not restricted to relatives of the employee, i.e. it's an open scheme. Tough times. This is an older slide that I've included. We had significant problems over Christmas with people wanting to give vouchers to employees in return for a Christmas bonus. I often get queries. I want to give an employee a 5,000 Rand shopping center voucher because they've worked so hard this month. No, cannot do that. That is a taxable fringe benefit. It's remuneration. The employee's getting paid because they're an employee working for an employer. Taxable remuneration. The last point is debatable. I go with no tax implication if your employer gives you a birthday or a gift for the birth of a child or sick relative or something like that. As long as the award is negligible, a bunch of flowers, hamper, you shouldn't have a problem with SARS. Okay, this slide is a duplication in terms of something we discussed earlier, and that regards retirement fund administrators and pensioners. Just to remind you again that if you are a pensioner with multiple sources of income, SARS does try and encourage you to increase what those various fund administrators deduct so that you don't have an amount owing on assessment. They send an annual letter out, and I've been getting them in the last couple of weeks. But you can choose to have your fund deduct tax according to the tables in each of the funds if you know that you're not going to owe money on assessments. Tax implications of retirement fund withdrawals where an individual ceases to be a tax resident, becoming very common. And our tax team in Hilton are very, very busy on these. So if you want more information in this space or you want to consult, please let me know and I will introduce you. And this slide specifically deals with retirement fund withdrawal. Now, what the legislation currently says is when you cease to be a resident, you immediately are deemed to have sold your fund, and the money accrues to you, and you have to pay tax at that point. And that can be very inconvenient, particularly if you've incurred a lot of expenses to emigrate. You also wouldn't have the cash available to pay the tax. So what SARS are looking at is that the tax liability would only be owing to SARS when the individual is actually paid by the fund. So, if we're going through a very, very bad phase in the market, it might not be a good idea, particularly if you're immigrating now, to have your retirement fund cashed in, because you may take a big hit. So as I've said there, the tax is due once the liability accrues to the individual, which is when immigration takes place, even though they may prefer to leave their retirement investment in South Africa. And I think SARS might go this route simply because it makes sense to obviously leave that money in the South African economy. Clarity is still required regarding the recent introduction of the 3-year waiting period before you can take money. Think of your RA. If you haven't been submitting tax returns for 3 years to say that you're out of the country, you're a non-resident, you're going to battle to take your RA. There's lots of comments. There's lots of various interests at stake. So watch this space. As information becomes available, I will publish it in our newsletter. Okay, moving on to learnerships. This was first introduced way back in 2001, and it's been extended numerous times. Most recently, it's been extended to April 2024. It's introduced to encourage skills development, job creation. It has more of an income tax implication for the company than obviously an individual. And the aim is to encourage employers to train people in categories where there's a high demand for skills. Then we've got my last bullet point there, the SARS form that you need to fill into to get this deduction. Only the lead employer can enter into an agreement with the learner. This is usually the employer paying the remuneration. So lots of companies try and share learners so they can all get access to this income tax deduction. SARS issued correspondence recently to saying that it's only the employer, the main employer, paying the remuneration and claim this benefit. As I said, it's an additional tax deduction for employers, and it's in addition to the actual salary expense that you're paying that employee. And this has two components. The first is the annual allowance component. So every year that this learner's on board, you can claim this annual allowance. Remember, pro-ratering if they're only on for a portion of the year. And then in the year that they complete this learnership, you get the completion allowance. The value of the allowances differs depending on the NQF level, and the value of the allowance increases if the learner has a disability, as in all other cases. Remuneration paid to a learner is subject to PAYE and the national minimum wage. This is regularly overlooked in payrolls. Here is the learnership allowance summary table. Shows you the NQF levels, and it shows you the learners, the employer's deductibility if the learner is disabled or not. Okay, so it's a useful program to address skills shortages. May allow qualified people to be exposed to practical experience in their study field. I think that's very, very important, in that without practical experience, it's very hard to get a job. So it makes sense that once you've got qualification, that you be put on a learnership. I'm dealing with, internships. An internship is not the same as a learnership. There's no specific tax deduction as annual or completion, but with your internship, there's no specific time frame. It would depend on the needs of your company. Bear in mind that it's important that you don't keep a person unnecessarily long on an internship without access to all other benefits that employees get, because you could get dragged to the CCMA. Interns are generally paid a stipend to cover food and transport costs, puts the intern in the shop window. And in our experience, you know, a quality intern with good work ethic is taken on as a permanent employee. And generally the stipends are below the tax threshold, so they wouldn't be PAYE. The official rates of interest. I've included this because we've had a few increases in the official rates of interest in the last year. The term official rate of interest is defined in Section 1(1) of the Income Tax Act. The official rate of interest is effectively the repo rate plus 1%. Taxable fringe benefit arises if the employee gets a loan from the employer at a rate that is lower than the official rate of interest, as I mentioned earlier, 8.25%. So if you are taxing them, if you are charging the employee 5%, then tax would be calculated on the difference between 8.25 and 5% on a monthly basis. If you're charging no interest, then 8.25% of the loan would be calculated, and that amount would be put into your taxable income. This is an issue that is rarely correctly applied by employers. In my audits, 9 out of 10 companies are not doing this correctly. There are some exceptions though, in terms of these loans. If your aggregate loans are less than 3,000, there's no interest applicable. If the loan is for study purposes, the 8.25% doesn't apply. Or if the loans are used to assist you to provide low-cost accommodation, and that is employees earning less than 250,000, there would be no tax implication. As I mentioned, the 8.25% is effective 1 February. So as soon as the repo rate changes, the official rate of interest changes on the first day of the following month. I'm quickly going to go through the home office concept again. I know it was dealt with last year, and if you've attended my home office webinar, you would have also seen this. We've been asked to include this because we get lots of queries on this. And I think the home office concept was really highlighted when COVID came about, and we had everyone working at home. Literally overnight, employees had to make a plan and be productive and client facing. But you know, home offices haven't just come in with COVID. There has been a move to people working from home to ease traffic congestion, particularly with the cost of office space, you know, and I found as an individual, I'm significantly more productive working from home because I'm available to work without having to commute, you know, with Teams and Zoom. I can have meetings. I'm not traveling as much, and it is a really good concept, but there is a downside, and the downside is people who are not disciplined, or people who do not understand the concept of productivity and client service. In red there, I've mentioned that an article I read online earlier this week said that up to a third of people have not returned to work and are working from home going forward. In terms of the tax legislation around home office, your deductibility is generally based on the general deduction formula, Section 11A, which is your main deduction formula. There's no specific legislation in the Income Tax Act that talks about home offices. There is another section, 23B, that talks about you cannot claim private or domestic expenses. So if you do not do the home office thing correctly, expect SARS to throw Section 23B at you to say that those expenses weren't incurred in the production of income or in the course of your job. And yeah, I talk about the bottom bullet point, there being exceptions where your private residence is used partly for trade and partly for private purposes. It would obviously make sense that there be an apportionment, which I will explain now. First step in the process, it's important that your employer put in writing, so either a letter or an addendum to your employment contract to say that you are required to work from home, and generally that you do not have an office provided by your employer. We're going to go through a couple of issues that I'm going to repeat just now in terms of the downfall of the home office concept. And the first is more than half of their total working hours must be working from that home office. The term mainly is important. So you must spend more than half your time working in that office. You can't say that you're on the road all the time and have a massive travel allowance and then say that you spend more than half your time working in the office. So I was going to catch you out. The employee must have an area of their home which is used exclusively for this purposes. We're going to talk about that at length. The office must be specifically equipped for the employee's trade. So your spare room with a sewing machine, the gym equipment, sports equipment would not cut it. It has to be a room utilized solely for trade. In one of my tax returns, they asked for a copy of, they wanted photos of all four corners of the room. And they're not asking that because they want to see how great my clients' decorations are. They want to see whether they can see other equipment or proof of it not being exclusive use for business purposes. The types of expenses that could be claimed are your interest on your bond, your rental paid, repairs and maintenance, lights, water, maids, wages, household insurance, rates, security. Then you've got expenses that are specific to the space. They are wear and tear on assets in the study, repairs specific to the study, and books. So the the previous slide, this slide, these are all expenses that are going to be apportioned because the maid works in the whole house, not just your study. And then these are expenses that are specific to the study, which you can claim it for. Expenses that you cannot claim, which a lot of taxpayers incorrectly make an error on. Home and cell phone expenses, general home repairs and stationery. If you're going to have a phone in that office, you would have to enter into an agreement process with your employer to reimburse you for the cost thereof. You can't claim that in your home office calculation. Step one in the calculation is to calculate the square meterage of the home office in relation to the total home. So if your home office is 10 squares and your total home is 100, you can claim 1/10 of those common expenses. Okay, so points 1, 2, and 3, follow that process and you should be fine. Unfortunately, there is one slight downside, and that is capital gains tax implications. So if you are using your home office when you sell the property, there is going to be an impact on the exemption that you receive. And what I've done is I've given an example here. You get a 2 million rand exemption on the sale of a primary residence, but in this case, this person worked, of the 10 years that this person owned this home, for 5 years in a home office, and 10% of the home office was used, 10% of the home was used as a home office. So in this case, you would apportion the 2 million by saying you only worked in it 5 of the 10 years, and only 10% of the home is used as a home office. So you've got this 100,000 rand capital gains tax problem. Okay, so you now no longer have the 2 million exemption. You've only got 1.9 million because the 100,000 is taxable. And if you have got a 2 million gain, you're now going to have to pay capital gains tax on this 100,000. The good thing being, though, is the first 40,000 for each taxpayer capital gain exemption is tax-free. So now you've only got a 60,000 capital gain. And those of you who know capital gains tax will know that there's only a 40% inclusion rate in your taxable income. So in this case, with this employee selling their primary residence under these circumstances, they would effectively pay tax on 24,000 Rand because of the use of the Home Office. Now, obviously, the tax that they would pay on the 24,000 would depend on which tax bracket that they fall into. Now, in my opinion, this is a small price to pay if you're claiming a massive tax deduction for your Home Office on an annual basis. But it's something that SARS are going to flag. If you are claiming a Home Office, somehow they're going to flag that when you do the sale, if your property is worth at the limits that we're talking about, that you are going to do this declaration. So what are the challenges so far? SARS has rejected up to 80% of the Home Office claims. I can understand why, because the ones that I've done have been 3 separate interactions. So letters have gone backwards and forwards 3 times. Officers do not meet the requirements of a Home Office. There we go again. You've got a chair at the dining room table, or you're in the hall, or you're in the telephone cabinet. That's not a Home Office. They're not exclusively used for business purposes. So your spouse's gym equipment is in there, the kids' toys are in there, you're going to fall foul of the legislation. It's not adequately equipped for business, so you don't have your laptop or your computer or printer, scanner, etc. in there, they're not going to believe you. It's not mainly used when you're working, so you're out of clients more than you're in the office, you're going to fall foul of the legislation. Often people do incorrect apportionment of their property. The other error is incorrect expenses claim. They claim the capital portion of the bond. You can only claim the interest on the bond. Some people are also claiming stationery and phone expenses. You cannot claim that. So in most of the cases I've dealt with, there's been sort of 3-month tie-up of your refund. So my parting question there is it worth the effort and the stress? Transferring employees, we've got 3 major exemptions. Transportation costs of the members and their possessions can be paid by the employer. Certain costs on the disposal of the employer's residence and then temporary accommodation. Your employer can put you in another city and pay your rent for up to 6 months tax-free. These are just some examples of the types of expenses that you can claim. You can look at those in your own time. Expenses that you cannot claim: architect's fees on your new residence and loss on the sale of your previous residence, but that's quite a limited exclusion. And then I've put the IFE5 qualifying codes. Qualifying expenses will go to code 3714, and non-qualifying expenses will go to your taxable other allowances 3713. Previously, prior to March 2016, it was practice that your employer could simplify this process significantly by just giving you 1 month's tax-free basic pay. That fell away. Employers are still doing that. Even big employers, you can't do that. Employers now have to provide costs actually incurred, so you would have to do a nice schedule, staple the invoices, hand those to your employer for them to be able to reimburse you tax-free. I'll put a caution in terms of transferring employees on probation. Be very careful how you word who's going to pay what costs, why, and when. If you are required to pay back transfer costs and your employer writes it off, that would be a taxable fringe benefit. Keep all the paperwork, keep a system, make sure there's a signing process in the chain of command so that when you get audited, you don't have a problem with tasks. Okay, this, I'm not going to go through this slide because we are getting on in time, but this is just your SARS BRS changes, your business requirement specification changes. Quite a technical slide. Have a look at that, please. You'll be happy to know e-filing is having an upgrade. SARS have moved all their development in-house, and a lot of these processes have commenced in preparation for their Vision 2024. Big things are happening at SARS. You're probably going to soon have a new commissioner in the new year. Digital platforms have been highlighted as key to the SARS new strategy. SARS are going very technical. You would have noticed if you've looked at their recruitment drive, less recruitment of auditors, more recruitment of technical IT specialists. And they're looking at all their vulnerabilities with these new people. The payroll auditors group have seen the proof of concept, and it is very modern indeed. Okay, moving on to UIF. This slide just talks about the online system to get UIF compliance certificates. I've covered in my seminars before the challenges that we've had. The challenges include doing an online request for your certificate and having rejections going back to the early 70s. We just couldn't resolve these issues. People couldn't get certificates. You know, you can be compliant one day, non-compliant the next day for no reason. Errors come out of the woodwork, not getting feedback. The payroll auditors group and SAIT and SAICA have had massive problems with the Department of Labor. So what happened was near the end of last year, the electronic UIF compliance certificates were done away with, and you had to go to a manual system. But you know what my clients have been doing is just attaching a letter to say that the system is down until further notice. And on a lot of tenders, the UIF compliance certificate has not been made mandatory. This obviously took pressures off companies, but the Department of Labor are looking at interim remedial methods to improve efficiency in the space, but they're not prepared to spend too much time on it because they're looking to implement a whole new system. The time frame on that, I'm not quite sure, but we're hoping that by the second or third quarter of this year, we'll have changes, the remedial changes to their current system. So the new system will look at improvements to the bulk upload facilities. Validation issues will be resolved, and the EDIC project, the EDIC file and challenges around the EDIC file will be resolved. This is just a copy of the letter that was issued by the Department of Labor saying that the compliance certificate system was problematic. We're seeing more frequent audits by the Department of Labor. We're seeing fines for non-compliance. So I've included this slide so that you can see that there is an audit process. Follow these instructions and you should be fine. Make sure that your BCA poster and all your posters are up. Make sure you've got a readily available list of employees signed off attendance register or clock cards, signed contracts and pay slips, proof of UIF and workman's comp registration and proof of payments, and then a company letterhead, your CIPRO registration documents and management names. Now I found if you've got this stuff ready, this process is very, very simple. The most recent ones I've literally had someone in here for half an hour looking at this documentation. They can see you've got your act together, they move on. If you don't and you're stammering and stuttering, you're going to have a problem. Moving on to COID and COID thresholds. Your payroll system would have already been updated. As of 1 March 2023, your COID threshold is 563,520. So that means that your payroll system will only calculate COID up to that employee's salary value. Your payroll system generates COID reports, so you use it, for the limitation of COID calculations, and use the COID report as the basis of submitting your annual return of earnings. Remember that those return of earnings must be in by the 31st of May. So the system should be open as of 1 April to 31 May for you to submit your last return of earnings for COID purposes. The annual return of earnings must include temporary, permanent, and casual employees. People often leave out temporary. You have a temp, or casual person injured on site, and they're not in your COID reports, you've got a problem. Learners and students, anyone undertaking work that are outside the main payroll, I will consolidate those people onto the consolidated return of earnings. 10% penalty is charged on the late submission of a return of earnings. Remember the difficulties you have if you are under audit for COID purposes. Make sure your figures are accurate and you do not make mistakes. This slide is just the back of the return of earnings manual form. I included it so you can see exactly what is included in COID earnings and what is excluded in COID earnings. Your basic conditions of employment earnings threshold has changed as of 1 March to 241,110.59 cents. And this rate is the rate at which anyone who earns above this is not entitled to receive overtime or automatic protection in terms of those bulleted points. Once again, your payroll should be set up to deal with that. National minimum wage. We had a government gazette in February, on the 21st of February 2023, to confirm the national minimum wage is now 25.42 per hour, and that applies also to domestics and farm workers. It does not apply to public works, extended public works program workers. They get 13.97. And if you've got learners, you need to go online because there's a table for learners in the various industries. Just an anomaly that I wanted to bring to your attention. The BCA defines an employee to exclude independent contractors, whereas the minimum wage includes independent contractors. So if you've got independent contractors that you pay, you have to ensure that they are paid at the national minimum wage. This slide just helps you with the definition of wage, money, remuneration, independent contractors. Important read if you want to know what you need to include in remuneration or wage in terms of the basic conditions. I've got 2 slides in the webinar for Poppy. There's 8 conditions for lawful processing. And I'll go through them very quickly. There must be an appointed information officer that is accountable to senior management in each organization. There must be limited processing of personal information. The processing must be lawful. You must specify the purpose for dealing the information. It must be specific, explicitly defined, and there must be a lawful purpose. There must be limited further processing, only with the consent of employees. There must be reasonable practical steps to maintain the information quality. There must be legal requirements to collect the information. There must be security safeguards. And the employee has the right to know the type, quality, and level of detail of the information held. More importantly, though, is there must be regular reviewing in terms of user access. So you must have systems that show that there is control on user access. Then what has been accessed and how has been changed in terms of environmental rules, system rules, data. There must be an audit trail to prove who has that access and that you have got systems in place to prevent unauthorized access. Yeah, we call these data change logs in terms of that audit trail. Yeah, look, if you're a hosting environment, there's certain information that has to be maintained and processes that have to be followed for you to meet the terms and conditions of the POPI Act. And the more you deal with third parties, the more you realize how serious POPI is, and those third parties want comfort that you are working within the law. Okay, and then just our last slide. I put this on just to annoy you. Actually, there's of the 60 million people in South Africa, there's only 22.9 million registered taxpayers. 19 million employees' tax certificates was issued in 2022, and those only related to 13.6 million taxpayers. 5.8% of taxpayers are paying 92% of the personal income tax and 85% of the VAT. And shockingly, 1.9 million taxpayers contributes 80% of the income tax collected. So, as a parting shot, if you're one of those people paying large amounts of tax, you've got potholes, bad service delivery, you've got every right to do so. On that negative note, that's the end of the session. Sorry that I've gone over the hour, but we did have a lot to go through. I'm just going to quickly go through the questions. Thanks, Paul. Paul mentioned thank you gifts in the form of vouchers to non-employees. Yeah, look, Paul, if they're non-employees, you don't have an employer-employee relationship, so you're not paying them remuneration. I assume that you're talking about your state educators. Yeah, dodgy, man. I never like to use terms like your efforts during the year. I prefer to use it some sort of humanitarian gesture, year-end, Christmas, holiday voucher, or something like that. Try and muddy the waters. Okay, so yeah, Paul, leadership incentive asked a good question, and that is the leadership tax incentive. If you're in an organization that doesn't pay tax, then it's pretty pointless because you don't have taxable income. Also, if you've got a massive tax loss that you're working through, you're not going to see any tax benefit until the loss is utilized. So, yeah, that is not a huge value. Okay, in terms of disabled leaderships that are sponsored, that are not required full-time in the workplace, I don't think the law needs to say that they have to be in the workplace. As long as you are the primary employer, you should be fine. And in terms of learnerships, learnerships have their own table of minimum wages. So anything you pay to them has to achieve that minimum wage, and it would depend on your industry. So it would be wise to contact your SETA to find out what the minimum wage is for your specific industry. Paul, again, interest fringe benefits. Now, in terms of buying alternative electricity supply, we are looking to buy inverters and batteries for our staff. Do we just purchase them outright, or can we do better if we purchase and raise a staff loan? Look, it depends Paul, depends which way you go. If you're going to go the loan route, remember they're going to have to pay 8.5% interest on that. if you give them those inverters, that value, the market value of the purchase, is going to have to be added to their taxable income, and they're going to pay tax on it. So you do have options. But yeah, I am aware that Rob Nowicki in his webinar covered all those elements. But in terms of a summary, this does create a benefit to the employee. If it's going to belong to the employee and you raise a loan, you're going to have to put that loan into payroll and recover it on a monthly basis with interest. That's probably a cheap alternative, because you're only paying tax on the 8.5% interest, as opposed to the employee getting a loan somewhere else and paying a fortune. Or, as I said, buying it and actually giving it, then the total value would be taxable in the month that the employee got that. Okay, that's the end of the questions. Anyone got anything for me? They're welcome to email me at Dave, D-A-V-E, at hrtorque.co.za, or 082-378-5655. The other alternative is you can go onto our website and book a free 15-minute consult with me via Calendly. Folks, I don't mind answering the odd question, but obviously if there's consulting, I will confirm my consulting rates. We will continue to have webinars, and we will continue to do newsletters and probably smaller webinars on more specific issues. I am away from this Friday till after the Easter weekend, so if you get an out-of-office response, I will only be able to respond to you after that. But thanks for your time. Really appreciate you all logging in, and I look forward to presenting to you soon. Have a good day. Bye-bye.